Warren Buffett once said, "The best investment you can make is in a business so good that even a fool can run it." But what if I tell you there is a company in India that does not even need customers to remember its name? Yet, it quietly powers more than two-thirds of India's mutual fund industry. In fact, CAMS services nearly 45 trillion worth of assets out of roughly 67 trillion industry AUM. That is about 68% market share. So every time you invest in a mutual fund, every SIP you start, every redemption you place, there is a very high probability that this one company is sitting behind the scenes processing it. And here is the interesting part: it's not a mutual fund, it's not a bank, it's not an AMC company, it is financial infrastructure. CAMS serves 10 out of top 15 asset management companies in India. It processes around 89 crore transactions annually. It handles nearly 186 trillion rupees in pay-ins and payouts. It maintains over 18 million KYC records, and it has number one SIP book in India in terms of folios received. Today, we are talking about CAMS, Computer Age Management Services, a company that controls roughly 68 to 69% of India's mutual fund RTA market share. This is not a hype stock. This is not a story stock. This is a toll collection business on India's financialization wave. And in this video, I'll break down what exactly CAMS does, why its moat might be stronger than you think, why entering in this industry is extremely difficult, its financial strength, and finally what the charts are telling us right now. Because sometimes the biggest money is not made in the front facing brands, it's made in the back end monopolies. Now, before we move ahead, a quick disclaimer: I am not a SEBI registered investment advisor, I am not a financial advisor. This video is made purely for educational and informational purposes. All views expressed here are my personal analysis based on publicly available data. I do not recommend buying or selling any stock, mutual fund, or financial instrument. Please do your own research and consult your financial advisor before making any investment decision. Now let's understand what CAMS actually does. In simple words, CAMS is the backbone of India's mutual fund industry. Whenever you invest in any mutual fund, you see the AMC name like SBI Mutual Fund, HDFC Mutual Fund, ICICI Prudential. But behind the scenes, someone has to process your transactions, record your units, handle your KYC, manage your SIP data, and maintain regulatory records. That someone is usually CAMS. So CAMS is what we call a registrar and transfer agent, that is RTA. Think of it like this: mutual funds manage money, CAMS manage the data, transactions, and investor records. And here's the scale: CAMS handles roughly 68% of the mutual fund industry's assets in India. That means if India's financialization grows, if SIP number grows, if retail investors increase, CAMS automatically grows with them. Now let's talk about its moat. Why is CAMS moat stronger than most people think? First, switching cost. If a mutual fund wants to shift from CAMS to another RTA, it is not like changing a regular vendor. They would have to migrate millions of investor records, historical transaction, compliance documents, API integrations, distributor systems, everything. One small error can create massive operational risk. So practically, once a client is onboarded, they rarely move. Second comes the scale advantage. CAMS has been building this infrastructure since 1988. It has physical service centers, digital platforms, call centers, and regulatory integrations across India. A new competitor would need years and huge capital just to match the operational scale. Third, trust and regulatory barrier. This is a highly regulated space, and mutual fund companies cannot experiment with unknown players. Trust in financial infrastructure takes decades to build, not quarters. Now, let's talk about why entering this industry is extremely difficult. Number one, high technology complexity. You're not building a simple SaaS product, you are building a national level transaction processing engine, handling crores of transactions securely. Number two, regulatory approval and compliance cost. Licensing, audits, cybersecurity infrastructure, it is expensive and time consuming. Number three, client concentration reality. The biggest AMCs are already tied up with CAMS or existing players. Breaking those relationships is extremely hard. And that is why CAMS behave more like a toll collection business on India's investment growth. It does not take market risk, it does not manage portfolios, it earns fees for servicing assets. Now let's move from story to numbers, because in investing, narrative attracts attention, but numbers build conviction. So as of today, CAMS has a market cap of around 16,797 crores rupees, and the current stock price is around 678 rupees. Now let's talk about valuation, because the current PE is around 37.8. If we look at the last 5-year average here, so it is 44.3. And since the company was listed in 2020, we only have 5 years of public data. So effectively, its historical PE is 44.3. So today we are getting this business at a lower multiple compared to its historical average. Now I'm not saying it's cheap, but relative to its own history, valuation compression is visible. And sometimes quality business becomes interesting when multiples cool off. Now let's talk about quality. If we see, ROCE is around 55% and return on equity is around 44%. These are not average numbers, these are elite level capital efficiency numbers. High and consistent return ratios tell us that this is an asset light, cash generating platform business. This is what platform economics look like. When a company generates 40 to 50% returns on capital consistently, it tells you pricing power exists. Now let's check quarterly numbers. If we go down and see the latest quarterly result, this is the highest ever quarterly sales ever recorded, highest quarterly net profit ever recorded. So operationally, the company is hitting new highs. Now, when price is correct but earnings hit record highs, that is when serious investors start paying attention, because price is volatile, earnings are structural. If we go to the profit and loss statement and see year on year performance, again we see highest ever sales recorded and highest ever net profit. So this is not stagnation, this is consistent growth at scale. Now let's go to the balance sheet, because balance sheet tells you risk. Now if you look at here, the reserves have gone up from 215 crores to 1078 crores now. That is almost 5 times growth in around 10-11 years. That shows internal profit compounding. Now if you look at the liabilities, only around 65 crores, so debt is minimal. And if we look at the cash and cash equivalents, it is around 235 crores. So effectively this is a low debt cash generating company. Now, this is very important. Let's go and see who owns the business. And let's move to the shareholding pattern. So, FIA holds around 45%. Yes, they have reduced slightly from 55% to 45% recently, but interestingly, DIIs increased their holding from around 17% to 22% now. So domestic institutions are accumulating. Public holding increased from around 28% to 33%, but within that public category, if you see and go down, around 3% held by Ashish Parthaswamy via HDB Welfare Trust, which again is a strong hand. So effectively, nearly 70% of the company is held by institutions and strongholders. This is not a trader-driven stock. This is institutionally dominated ownership, and strong hands reduce volatility. All right. So fundamentally, we have discussed the business, we have seen the numbers, we have checked the balance sheet strength. Now let's answer the most important question. What is the market doing with this information? Because remember, fundamentals tell you what to buy, but technicals tells you when to buy. Now let's see its technical analysis. Now you can see it, this is the long-term daily chart of CAMS, and the first thing I want you to notice is the stock peaked at around December 24 at approximately 1065. From that peak, it is currently down by 36%. Now many investors panic when they see a stock 30 to 40% correction. But let's zoom out, and if you look at around 22-23, the stock had corrected nearly 50% from its previous high, almost half its value wiped out. And what happened after that? It did not die, it did not break structurally, it recovered and went on to make new highs here. So this is very important. Strong stocks don't move in straight lines; they move in waves. Healthy businesses often go through unhealthy looking corrections. Now, if from its current price of 677, if the stock goes back to its previous high of 1061, there is a potential gain of 56 to 57%. So fundamentally, we have a high quality infrastructure business. Technically, we are in a correction phase, but corrections are not unusual in strong stocks. The real wealth is created when strong businesses go through a temporary price weakness. Now, the final question becomes, is this a normal cycle correction or the beginning of structural weakness? This is what investors need to evaluate calmly.